All right. Happy Monday, Tuesday, Wednesday, whichever day you are listening to this episode on. We have another episode of the Real Estate Investing Club for you guys. Today we have Ryan Strub with us from CrowdStreet. CrowdStreet does syndications. They're a platform that raises capital for projects to allow individuals like you to invest in projects that you otherwise would not normally have access to. So I'm super excited to have Ryan here. We can jump into this. Ryan, thank you very much for hopping on the show.
Yeah, Gabe, thanks for having me. I appreciate the invitation.
Absolutely. I told you before we got on here, we like to start with stories. Everybody's got a good one here in real estate, and I'm sure you are no exception. So why don't you take us back to the beginning? How did you get started in real estate in the first place?
Well, I like that mentality. Real estate really is about stories on, all the acquisitions and stories for the deal. So happy to start there. My name's Ryan Strub. I'm the head of commercial investments at CrowdStreet. So I currently work with our investments team, sourcing, structuring, underwriting, and ultimately approving deals that we put up on our platform. Going back now 15 years when I first got into the industry, I actually joined on the construction side of the business. So I was in commercial construction for the first 4 years of my career, working as a project manager, estimator, design build contractor based out of the Midwest. This was back in just right before the great financial crisis. I'll call it 2006 to 2008. That company obviously scaled back a little bit, went from like 135 employees down to like 30. So my first job out of college ended pretty shortly. Ended up getting into the real estate side of the business actually through that. As a broker. So I was a real estate broker for a couple of years, trying to weather the storm, and really wanted to put together those two passions, the construction side of the business, with the sales side of the business. So I ended up getting into real estate investing out of grad school, got my MBA in finance from Oregon. So I'm in Portland right now, got my MBA from Oregon, and joined a real estate investment company here based in Portland. Was the vice president of acquisitions for them. And we focused on, major markets, Denver West, so Denver, Seattle, San Francisco, Portland, Phoenix, Southern California. And there we were the operator, we were the GP. So we were partnering with institutional investors like Goldman Sachs, Investcorp, some of the bigger names there, raising the LP portion of our capital stack from them. And then we were syndicating the GP position from accredited investors across the country. Did that for a couple of years, and on one of the projects that we worked on, we ended up looking to CrowdStreet to actually raise that GP portion of the equity. So I've raised capital from CrowdStreet back in the early days. This was kind of 2015, 2016, and ended up doing 3 projects with CrowdStreet, 3 very different projects. A multifamily development here in Portland, a $200 million core office building in Washington, D.C., and then a mixed-use project down in Phoenix. And after the third one, I just saw all of the growth potential in this space, in the online syndication space with CrowdStreet. So I called a friend of mine up, who was the chief investment officer of CrowdStreet at the time, and asked to join. So I've been here now for about 5.5 years, have worked on the investment side of our business and the capital market side of the business, really sourcing the deals, building relationships with sponsors, and helping us grow from, raising, call it $1 million per deal to today. We're doing 10 million plus, and actually in 2022 had our 2 of our biggest raises of all time, raising well over $30 million per project. So it's been an exciting ride, and we're excited about it.
Man, I love that. That is a great trajectory. And I always am a little jealous when I hear people who got started on the construction side of things, because, real estate on when you're doing the investment, it really looks like a bunch of numbers and people. But when it comes down to it, it is physical things that we're dealing with. So if you understand the construction side of things, you have a back view into how this stuff is created. So love that you came from construction, and then from there you've done tons of stuff. A lot of good experience there. So I'm trying to think of what direction we can take this. One of the positions that you had was the VP of acquisitions. Every deal starts with finding the actual deal. So I'm sure you got a lot of experience that we can go into there. We're in a market that's a little bit funky. I feel like expectations with sellers are still a little misaligned to the current, interest rate market and all that stuff. So kind of take us into acquisitions and how you treat that, how you go about finding good deals in tough markets.
Yeah. So, I mean, you started the podcast out talking about stories. I think every real estate transaction really has to have a good story to it. And, you mentioned sellers haven't quite come off their pricing expectations. So as debt has gotten more expensive and also more limited, right? It's really hard to put together a capital stack today. So when we look at an acquisition, number one, we want to have a good story behind it. Is it a market that we want to be in? Is it an asset type that we feel like has growth potential? And then the third one, which is really big today, is are we getting in at a good basis? We look at every deal right now very simplistically, which is, what is the yield that we can generate and where do we think we can sell the asset? So taking that return on cost, that spread over the exit cap is really where you make your money. So we try to keep it simple from that perspective. And then also, we lean heavily on how the debt is being underwritten as well. We're seeing a lot of negative leverage in the market. When I say negative leverage, I mean your cost of your debt is actually more expensive than the stabilized asset itself. That's really difficult to assume that you're going to have a bunch of growth in your rent and be able to cut expenses to offset that.
Let me jump in there, right? So when you do, because obviously this is happening, so people are buying assets at that rate. Is the expectation that they're just leaning on appreciation? They're just leaning on rent appreciation in the market, or if it's if it's a multifamily or whatnot, or I don't ever see a use case for buying a property that would lose you money, but obviously at different levels, there's a different justification. So what is the justification to buy a asset that's actually has a negative net cash flow?
Yeah, so there's really two different ways that people look at it. Number one is what value can I add to the project that's not being extracted today? So if you feel like your ownership team and your operating team can come in and run that asset more efficiently, that's one justification for it, right? You think that you can come in and really push rents, operate the business more efficiently, create some positive cash flow. And then the other one is that you really feel bullish on the market. So, we do see this with investors or sponsors who are looking at more like 10-year holds. They're saying for the first couple of years, maybe I'll have negative leverage, but as I run this thing for years, 4 through 10, which is really what I'm getting into it for, that's when I have that appreciation and can feel better about it. So either long-term holds or I can add value through the operations.
Gotcha. Yep, that makes sense. And when you guys are building out your business plan for each project, what is the general exit timeline that you guys are looking at? Are you doing 3 years, 10 years? What are you looking at?
So overall, historically, we've done 3-year holds. Our track record right now, which has over 150 realizations, the average hold period is 3 years. Obviously, if we had a 10-year hold, a couple of years ago, we weren't going to come to fruition yet. So we will start to see that increase a little bit. But typically, our investors want to get in, add value, and get out. So we have, primarily 3-year holds. We do have some core plus deals that we're looking at 5 to 7-year holds. And then we also have some 10-year holds. We have a lot of opportunity zone investments that we've made that obviously have a 10-year horizon, and some core deals where you're really getting in and hoping to clip that coupon, call it 6 to 8% per year. And then your IRR is going to be somewhere in the ballpark of 10 to 12% at the end of the day after 10 years.
Yep. Awesome. That makes sense. So before I jumped in there, we were talking about the market and kind of the mismatch of expectations there. I want to take us back to that kind of line of questioning. Where do you see the market going? How do you see, the next year, 2 years in terms of just kind of the market in general? I know that's kind of a generic question, but where do you see the market going in the next couple of years?
So I definitely think that sellers are starting to come off of their expectations. We have seen that a little bit. It's not to the point that we thought it would be, going back 9 months ago. But you are starting to see distressed situations. So there's a lot of CMBS loans that are maturing in 2023. That's going to, force sellers to either refinance it at a difficult time or sell that asset. So we do think seller expectations are going to come down a little bit further. And we have seen distress in the market too, right? There are non-performing loans out there that we've had a look at. We have had institutional investors who want to get out of an asset for a certain reason, whether their fund life is coming to an end or they feel like they've extracted enough value out of it. So we have seen some recapitalizations from GPs who are trying to get their current partner out, where seller expectations have dropped a little bit. We think it's going to come down a little bit more over the next couple of months before you start to see that equilibrium. So it's not quite there, but in certain situations, we have seen that come to fruition.
Okay, and so you guys are not seeing a huge dip in any of the markets out there. You think that it's gonna, there's so much doomsday speech out there where markets are gonna go to $0. Everybody's gonna just give their properties away, but you guys don't see a huge crash in any of the markets out there.
We don't see it right now, and again, I think that's going to be forced a lot by the lender terms. In 2020, we thought there were going to be a lot more distressed situations, lender workouts, for example. And what ended up happening was, lenders were very lenient in terms of, allowing properties to cash flow negative, and everyone understood that this was a once in a lifetime pandemic. So lenders were a lot more friendly than what we thought. We're not seeing that this time around. So as loans are coming due, interest rates have increased. There's really no reason for a lender to try to work out at the current rate. So, rates are increasing, especially on those floating rate loans. I think SOFR is 4.3% this morning. So, if you're getting a 425 over SOFR loan, you're over 8% in terms of your debt. Prep equity is also increasing. We're starting to see that creep up into the mid-teens, 13 to 15%, all in for a fairly small percentage of the capital stack. So we are seeing distress come. It just isn't coming in the waves, and that will happen as that debt continues to mature, and as people can't meet their extension options as well, right? Your debt service coverage ratios are much more difficult to hit today than when you originally put that loan on 2 years ago. So if you have a 2+1+1 or a 3+1+1, those plus ones are going to be very tough to execute on at the current levels.
Yep, makes sense. So you guys do our GPs on deals as well. I mean, CrowdStreet does funding for deals, but you also execute on these deals yourself, correct?
That's right. So CrowdStreet's unique in the sense that we can play up and down the capital stack. And really the value add that we have is we're providing passive equity to sponsors that can get to the scale of institutional investors, right? So if you're looking for a $15 million equity check to complete a project, historically, you haven't had very many options to go to. All of those options had massive control rights. They controlled major decisions like refinancing, selling, signing a major tenant in the project. Our investors don't want that hands-on experience. They want to make their investment, sit back and watch it perform. So we can play as a portion of the LP. We've had plenty of deals where we've been alongside institutional investors. We have had plenty of deals where we go side by side other high net worth investors that the sponsor has raised capital for. We do prep equity, so we're happy to play in that space. And we also do GP equity, where we get a percentage of the promote to be kind of a smaller piece with an LP partner coming into that deal. So playing up and down the capital stack is imperative for us. And, it's really trusting the sponsors. And it was interesting. Last year, we had over 75% of the deals that we did with sponsors who have done $500 million plus of historical capitalization. So these are the top tier sponsors across the country that are choosing CrowdStreet over institutional groups for that control of capital. So there are some pros and cons with every capital source. One of our pros is that we're passive, and that helps the sponsor out.
Yeah, absolutely. Do you guys kind of focus in on a specific type of asset, like a specific asset class, or are you agnostic? You'll do industrial, self-storage, blah, blah, blah.
That's one thing I love about this job is we do pretty much everything. And like I said, I run the commercial side of the business. So I focus on office, industrial, hospitality, retail, self-storage, life science, medical office. And then the other half of our business is multifamily. So historically, about 50% of what we have done has been multifamily. 50% has been commercial. So we're across the board.
Nice. I love it. Which of the markets? This is actually one of the questions in the quick question round. So I'm jumping the gun, but I'm going to ask it anyways. Which market out there are you guys most bullish on? Which one are you most excited about?
So every year we do our top 25 markets, and we break it down by asset class as well. So we have our overall markets, and then we have, each individual asset class we'll go down and give the top 10 on. We actually didn't do that this year. And the reason is because, we're really looking at the investment opportunity in this climate versus the actual market itself. So, if you're looking at a multifamily deal in Austin versus Raleigh, two great markets, historically we would have taken, Austin in some years, Raleigh in other years. This year, again, we're kind of focused on the story, like what basis do we have? Where are we in that micro market? We still do prefer Sunbelt states. So we're heavy investors across Texas, Houston, Austin, Dallas, the Carolinas, Florida. We haven't been as active in some of the West Coast states, so California for tax purposes. We don't have as much demand there. And then we do play up and down the East Coast as well. So Sunbelt states always work well. That's where investors want to put their money. And I think part of it too, you're obviously in Seattle there with the Space Needle in the background. I think sometimes it's very difficult for someone in Texas to see the price per unit that gets traded in California and in Seattle, for example, versus they look at theirs and they say, I'd rather be in at 180K a unit versus 435 a unit, over in the more expensive areas.
Yeah, actually, that's so when I first got started in self-storage, not too long ago, maybe a year and a half, 2 years ago, I really wanted to buy something in Seattle, something in Washington, and I was looking around and I just couldn't find anything that was just reasonably priced. It was the seller expectations were way too high, and I just ended up buying something down in Dallas. I love Texas, as all their markets out there. I'm selling one right now in Lubbock, but most of their markets out there are just crushing it, especially the triangle down there in the center. So Texas is definitely
absolutely
right on. Well, hey, I took a peek at the clock. It looks like we're crushing the time already. So it is time to go to the quick question round. Are you ready?
Sure. I'm ready.
Let's start with books or any form of education. Give me 2 recommendations, one for general life wisdom and one for real estate specific.
That's a great question. And I'll caveat this by saying I have a 1-year-old. So most of the books that I've been reading lately are for her, reading to her, Harold and the Purple Crayon, Strega Nona, all of those.
I love it.
I did recently reread A Ride of a Lifetime by Bob Iger. So as he transitioned back to Disney, I thought that was a great one to brush off. And those are my favorite types of books. I love reading biographies of business leaders or leaders in general. So that was a great one. Shoe Dog, another one, being in Portland, having that Nike connection.
Yeah, Nike.
That was there. And then in terms of, for the more dense books, the investing books, my favorite is The Art of Asset Allocation by Darst. It's not a book that I read through on a frequent basis, but a bunch of good chapters in there. So it's a thick one. It's a dense one. Don't recommend sitting down and reading it for leisure, but there's a bunch of good content in there if you want to do the chapter by chapter version of it.
Nice. I love it. We're actually, me and my girlfriend are expecting our first up in March. So congratulations to you. And I will soon be in the same boat reading those.
Ride.
yeah, I'm looking forward to it.
Congratulations to you. If you need more recommendations on that topic, let me know. We have a library of them.
Sounds good. All right, moving on. This one is for your younger self. Let's go back to the Ryan who was still back in construction, doing those projects. Go to him, look him in the eye, give him one piece of advice moving forward.
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast.
So I think it's all about confidence. Have confidence in yourself. In state of the fundamentals, I think real estate is a unique asset class where, you're not valuing something that has a negative income stream like a tech stock, right? The income, the expenses, you have comparable properties. So keep it simple, have confidence, pick your spots appropriately, but pull the trigger when you have a good opportunity.
Absolutely. Take action. We repeat that so many times on the show. If you guys are on the sidelines right now and you want to get into real estate, just do it. Just find an asset to buy and jump in. Moves us to the next question. We already went over this one, but I'm gonna put your feet to the fire and I'm gonna ask for one market. So give me one specific market that you're most excited about investing in today.
I'm a little biased by this, but I'm going to say Austin. Our company is based in Austin, Texas, so I have had the ability to travel down there a bunch. I love the city personally, and there's just still a great growth story there, and immigration story that's not going away. So Austin is my favorite market for sure.
Nice. I love it. Yeah, I went to Austin the first time like 5 years ago, but it was blast. I love that one street they have in the middle where they just shut it down during the night and all the bars are people can just walk in the street. It was a lot of fun. Moves us to the next one. This is about strengths. We are all gifted with strengths that we uniquely give this world. So what is your Superman strength?
I like to say I'm a problem solver. I'm a point A to point B person. So, maybe I don't follow the exact path that everyone else would, to tackle the problem. But at the end of the day, it's all about results. And can you get past that roadblock, solve the problem and move on? And again, say this very humbly, but I think I'm really, really good at problem solving.
Your man is absolutely necessary in real estate because, ladies and gentlemen, you are always going to be hitting problems day in and day out in real estate. So, got to have that problem solving tool belt in your tool in your tool belt. Good That's strength right to have. That moves us to the next one. This is about mentors. None of us are islands. We all stand on the shoulders of giants. So, who is one mentor who has contributed significantly to your career today?
Yeah, so my first boss when I got over into the actual investing side was a man named Bob Scanlon. Huge mentor of mine. I think he had been, in the industry for decades, so had, a wealth of experience. And the one thing that I really appreciated about him was that he took the time to teach that younger generation, help them understand the fundamentals. So Bob was a great mentor of mine. Still, used a lot of his advice today that he provided me over the years. So definitely Bob Scanlon would be my biggest professional mentor.
Awesome. Well, shout out to Bob. Thanks for helping Ryan get to where he is today. And that leads us to the second to last question. This is about tools. Tools form the backbone of every business. So what is one tool that you could not live without?
I love the analytical tools, the market research tools. So I'm going to go with CoStar for that one. I mean, the analysis they do on micro markets, the narrative they provide, all of the data that they have, especially for a group like us. I mean, we process 450 deals on average per year.
Wow.
So we're approving and launching, raising for about 100 to 125 per year. So obviously we don't have the luxury as a platform to go out to each of those markets. So we're, doing our analysis from 30,000 feet. Obviously lean heavily on the brokerage community, on the sponsors that are doing the deal, but we couldn't do our underwriting without a resource like CoStar.
Nice. Yeah. CoStar is a good platform to have. I use Crexy. It's a good one, but I think from what I've heard, CoStar is better. So great recommendation. That leads us to the very last question. This is for the listeners. You've given us a lot of good advice. I'm sure people who are interested in CrowdStreet and what you guys do over there would love to reach out and get in contact with you. What is the best way for them to do that?
So first of all, I would definitely recommend going to CrowdStreet.com. You can see our marketplace. Like I said, we do about 100 to 125 deals per year. They're constantly changing. So you're going to see a lot of deal flow if you go check that out. You can reach me at ryan.strub@crowdstreet.com. That's my email address. And then also follow CrowdStreet on social, LinkedIn, Twitter, Facebook, the whole 9 yards is a great place to get in touch with us.
All right, cool. And just to clarify, the people that benefit from CrowdStreet are both people with capital who want to invest in projects and people who have projects and need capital to be invested in those projects, correct?
That's right. Yeah. So we have a dual marketplace, right? So we have sponsors who are putting those deals up. We have investors who want to invest, and we provide diversification, right? I said we do every different asset type, different risk profiles up and down the capital stack. So whether you're interested in a core self-storage deal or developing a multifamily deal, CrowdStreet can provide all of those opportunities for you.
Right on. Well, again, thank you very much for hopping on the show. It's been a pleasure talking with you.
Likewise, Gabe. Appreciate the invitation. Great to chat with you.
Absolutely. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at the realestateInvestingClub.com. And if you guys want to support the show, all we ask is that you just give us a like, subscribe, share, all that jazz on whatever platform you're listening to or to this on. And if you guys have any questions, I've already covered that. So I hope you guys have an absolutely fantastic week. Keep rocking real estate. And I look forward to seeing you on the next episode. Thank you for joining us for another episode of the Real Estate Investing Club. I hope you guys enjoyed the episode as much as I enjoyed putting it on, and we're able to pull some actionable advice that you can apply in your own investing today in the field. Before you go, we have a gift for you. If you're a new investor looking to get started or an established investor looking to invest, take your investing to the next level, I've created an ebook just for you, available on our website. This ebook will cover how I was able to create both active and passive income in real estate with very little money to start with. In it, I will address the 3 most often cited obstacles new and veteran investors run into by showing you how to find deals that are actually deals, how to finance a deal with little to no money down, and how to exit those deals for maximum value. And if you get the ebook today, I am throwing in a bundle of bonuses, 7 of them to be exact. The first one will be the off-market lead generation blueprint, which will take you through the exact systems and processes we use to generate off-market leads like clockwork, which is the most important skill when it comes to creating wealth in real estate. The second bonus is the A to Z REI systems and vendors guide, which will allow you to peek under the hood of our business and see the exact tools, systems, and even the vendors we use to see the success that we do. And the third bonus is the top 100 best performing keywords pack, which will give you the exact keywords we use to target motivated sellers online using PPC ads. The fourth bonus is our contracts bundle for wholesaling and renting real estate, which will give you access to all the contracts we use in the field to execute all different types of transactions. After that is the Investors Quick Analysis Calculator and Offer Tool, which will allow you to quickly calculate whether a deal is an actual deal and will allow you to create an offer automatically from those calculations. This is a lot of bonuses that I said. I'm just going to keep going down the list. Number 6 is the Investors Daily Success Tracker, which is a tracker you can use to ensure you are taking the right actions day in and day out to reach your financial goals in real estate. And the last bonus is the Wholesalers Template for Quick Assignment Cash, which will give you the templates we use to present our wholesale deals professionally and efficiently to our buyers. Whew, that is a bundle. So it's a mouthful. You get all of those bonuses for free when you download the ebook. All we charge is the admin cost to run the show. So if you're interested in the ebook and the bonus bundle, head on over to the website at therealestateinvestingclub.com. Click on Get the Ebook Bundle at the top of the page to take advantage of that deal. And with that said, I hope you have a fantastic day, an even better week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.